Welcome to the Level 1 Derivatives Summary video series. This video is a summary of the reading on futures markets and contracts. A futures contract is an agreement between two parties in which one party, the buyer, agrees to buy from the other party, the seller, an underlying asset or other derivative at a future date at a price agreed on today. This looks a lot like the definition that we saw with forward contracts. The difference is that futures contracts are standardized. So there is a standard contract. The contract specifies the quality and quantity of the underlying asset, the delivery and settlement date, and the manner of delivery. The exchange specifies which contracts will be traded, determines the minimum price change or tick, and sets limits on daily price moves. The clearinghouse, which is part of the exchange, specifies margin requirements and acts as the counterparty to every trade. And because of this, the credit risk is essentially non-existent. Because of the standardization of futures contracts, they are more liquid relative to forward contracts. To close out a futures position, a trader simply enters into an opposite futures position. Other methods of settlement include the delivery of asset, cash settlement at contract expiration, or an off-exchange delivery called exchange for physicals. This slide is important. I have often seen questions that check whether you understand the difference between futures and forwards. Forwards are private contracts over the counter. They are unique or customized. There is default risk. There is no margin requirement, and there is little regulation. On the other hand, futures are exchange traded, they are standardized, guaranteed by the clearinghouse, effectively no default risk, there are margin requirements, and they are regulated. So these are the most important distinctions. Futures margin terms. So we'll go over these terms and then we will look at an example. Initial margin. This refers to the first deposit which must be posted before any trading takes place. Initial margin is fairly low and equals about 1 day's maximum fluctuation in the contract value. The key takeaway from this is that if you have an underlying that is very volatile, then the initial margin will be slightly high. If the underlying is not very volatile, then the initial margin will be relatively low. The futures market is characterized by marking to market, wherein any losses for the day are removed from the trader's account and any gains are added to the trader's account. Gains and losses are thus realized on a daily basis. Whereas with forward contracts, you realize your gain or loss at expiration. The maintenance margin refers to the minimum level that the trader's account can fall to, at which point a margin call will be issued. The trader will then have to deposit more cash or securities, called the variation margin, into the account to bring the margin back up to the initial margin level. Settlement price refers to the average of trades during closing period used to calculate the margin. Margin deposit can be thought of as collateral or as a performance guarantee or a down payment. It is not a loan. And this is another possible question where you might get something that says a margin deposit can least likely be considered collateral, down payment, or loan. And given that it's a least likely, the correct answer would be loan. This slide illustrates the calculations that you might need to do. Consider a futures contract in which the current price is 100, the initial margin is 5, and the maintenance requirement or maintenance margin requirement is 3. You go long 10 contracts. So how much do you need to post initially? 10 contracts times 5, so you'll have to post 50. So the way this chart is structured, or this table is structured, day 1 beginning balance is 50, that's how much you put in. And then initially you don't need to add anything because that's where you are starting. Let's say that the settlement price on day 1 goes down by 80 cents. So for a long party, that's not good. So you are losing. And how much are you losing? 80 cents per contract. You have 10 contracts, so 80 cents into 10, which is 8. Your balance is 42. Is this above the maintenance margin? Maintenance margin is 3 times 10, which is 30. Above that number, so you don't do anything. Next day, the price drops further. So it drops a lot. you lose 32 on your 10 contracts. Now we are below the maintenance margin. The next day we need to add enough money to come back up to the initial margin. So that is an important point. And then the rest of the numbers you can follow. Notice that at the end of every day we are marking to market. This is called daily settlement. So gains, losses are being realized on a daily basis. Here is another sort of question that you might get related to what we are talking about. Suppose that you go long on 10 futures contracts. The current price is 100. The initial margin requirement is 5 and the maintenance margin requirement is 3. When will you get a margin call? And what is the variation margin if the price falls to 97? So note that the difference between the initial margin of 5 and the maintenance margin of 3, the difference is 2. If the price falls by 2, so to 98, given that we started at 100, you will get a margin call. If an individual has to deposit 50 as initial margin for 10 contracts and maintain it to 10, if the price falls to 97, the individual loses 3 on each contract, losing 30 in total. This brings the value down to 20, and the variation margin of 30 needs to be deposited to bring the money back up to the initial margin. So here we'll just highlight how margin is treated in security markets versus futures markets. In security markets, margin indicates how much an investor can borrow, whereas in futures market, margin indicates how much a trader must deposit as collateral or a down payment or a performance guarantee. So the same word, but the meaning is very different. In the securities market, a 40% initial margin requirement means that the investor must put in at least 40% and can borrow 60. In the futures market, when we say 10% initial margin, the trader must deposit at least 10% of the asset's value. 25% maintenance margin in the security market means that the equity for the investor must be at least 25%. If equity falls below 25%, he only needs to add enough money to get back up to 25%. Whereas in the futures market, he needs to come back up to the initial margin. Now, this also is a very testable point. Treasury bills and Eurodollar futures. So these are instruments, or these are contracts, futures contracts either based on T-bills or Eurodollar futures. I have put them both on the same slide because as far as we are concerned, they are very similar. We'll start with T-bill futures contracts. Remember, they are standardized. So the notional principal has to be defined. The notional principal is 1 million and the underlying is a 90-day instrument. So 90-day T-bill with a face value of 1 million. These are cash settled. The price is quoted using the IMM index, and the way it works is IMM index is 100 minus the annualized rate. If you are told that the IMM index is 93.75, what is the actual price? So from 93.75 you can determine that the discount rate is 6.25%. That's the standardized, and it's just from this relationship over here. Rate is equal to 100 minus IMM index. So that's the rate. Then remember that these instruments are quoted based on a discount. So it's a discount yield. And this concept keeps coming over and over. You've seen it in quant, in corporate finance, in fixed income, and here in derivatives. So it's almost a guaranteed item on your exam. 0.0625 is the discount divided by face value, because it's a discount instrument, into 360 over 90. You can calculate the D is this number, and then the actual price is 1 million minus 15,625, which is 984,375. Then it can be shown that if the index goes up by 1 basis point from 93.75 to 93.76, then using the same calculation, the price is now 984,400. 1 basis point move is equivalent to $25. So this is an important point to note. In other words, if you've gone long and the IMM index goes up by 3 basis points, do you need to do a long-winded calculation, or do you automatically know that you gained 75? You gained 75. So you can do the calculation once to convince yourself. After that, you know for a fact that 1 basis point equals $25. And also note that the standard where we say that if the price goes up, then the long is happy, that remains. And that is why we have set up the strange convention of 100 minus something. So when the price goes up, the long is happy and the short is sad. Eurodollar futures contracts are based on LIBOR and are more active and more important relative to T-bill futures. They are based on 1 million notional principal and 90-day LIBOR. So it's the same, also quoted as 100 minus annualized 90-day LIBOR settled in cash, and 1 basis point represents $25. So essentially, if you get a question on the exam, whether it's a T-bill contract or a Eurodollar contract, you deal with it the same way. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.